Hey everyone, and welcome to today's Explainer. Today we're diving deep into a seriously advanced trading strategy known as positional entries. Look, if you've ever felt that absolute gut punch of frustration, watching the market just explode without you because you were sitting on your hands waiting for the perfect confirmation, well, you're in exactly the right place. By the time we wrap up today, you're going to know exactly how to position yourself so you literally never miss one of those sudden market expansions again. Sound good? Let's get into it.
Here is our quick roadmap for today. We're going to start by unpacking the missed expansion problem. Then we'll properly define what a positional entry actually is and walk through the strict fractal model checklist you need to follow. After that, we'll get into the critical nuance of respecting market equilibrium. And finally, we'll wrap things up with some essential risk, reward, and adjustment tactics.
All right, kicking things off with part 1, the missed expansion problem, or getting left behind at the open.
Let's start with a pain point I know we have all felt. Seriously, how many times have you missed a great trade just because it expanded right away? You're sitting there at your desk, you've done the work, you've analyzed the fractal model, and you've got your higher time frame closure. So you're patiently waiting for that intra-candle change in the state of delivery, or maybe a nice deep pullback to get you onside safely. But nope, instead the new candle opens and price just drops like a rock, aggressively expanding right out of the gate and leaving you totally behind. It is so incredibly frustrating to have the exact right bias but absolutely zero profits to show for it, all because the market didn't give you that textbook pretty retracement.
Okay, so how do we fix this? That brings us to part 2, defining positional entries and how we anticipate the move.
To completely solve this missed opportunity, we use an advanced concept called a positional entry. Basically, it means getting yourself onside before the fireworks even start. You're literally positioning yourself right at the open of a new higher time frame candle, often candle 3 in a sequence. You execute your entry right then and there at the open, and you place your stop loss on a previously formed valid protected swing. You do this fully anticipating that the price simply will not take out the previous high or low if it's truly gearing up to expand in your direction.
I think the core psychology here is captured perfectly in a quote directly from our source material, "I'm just entering at the open," under the anticipation that price shouldn't go take out this high, right? You are making a conscious, deliberate decision not to wait for a lower time frame confirmation to form a wick. You are actively trusting the structural setup that has already proven itself in the previous candle. If the market is genuinely going to move, that high simply shouldn't be breached, period.
And this really highlights the ultimate trade-off we face as traders. Think about it. On one hand, waiting for an intra-candle change in the state of delivery gives you that immediate confirmation. It just feels safer, right? But on the flip side, taking a positional entry guarantees you don't miss the boat when the market is primed for a massive, immediate expansion. You're essentially trading a little bit of lower time frame comfort for the absolute guarantee of being in the market when momentum shifts instantly.
But you can't just guess and wing it. Which leads us to part 3, the fractal model checklist and the strict rules for entry.
Yeah, you definitely cannot just enter blindly at the open of some random candle and hope for the best. That's a recipe for disaster. You have to follow a strict mechanical checklist based on the fractal model. It takes 4 steps. Step 1, you wait for a higher time frame closure, usually candle 2. Step 2, you identify a lower time frame change in the state of delivery. Step 3, and pay attention here because this is absolutely huge. You must locate a newly formed protected swing before the new candle even opens. And then, only when all those boxes are confidently checked do you move to step 4 and enter precisely at the open.
Let's zoom in on step 3 for a second, because it's the anchor of this whole strategy. What exactly is a protected swing? Well, it's a structural high or low that forms when price reaches into a fair value gap and then confidently closes through a series of opposing candles. Like, imagine price tapping a fair value gap and then closing through a series of up-close candles. That creates a structural barrier, and that barrier is your safe haven. It's a highly reliable spot for your stop loss because, structurally speaking, price has zero business returning there if the expansion is the real deal.
Now, markets aren't always textbook perfect, so we need some flexibility. Normally, we look for a candle 2 closure, often using things like SMT divergence with correlated assets to confirm it. But what if that doesn't happen? Well, the source material actually points out a great daily and hourly chart example in silver. There was no ideal candle 2 closure. But instead of giving up, the model just adapted. It looked for a candle 3 closure instead. The structural logic was exactly the same, and it set up a beautiful positional entry heading right into candle 4.
All right, moving on to part 4, and this is absolutely critical, respecting market equilibrium, or the EQ.
We've hit what is honestly the biggest nuance of this entire explainer.
This is literally what separates the advanced pros from the novices. Just mechanically finding a protected swing. Not going to cut it. Not all protected swings are safe to use. Your stop loss must be placed relative to market equilibrium, the EQ. The swing you pick has to give the new candle's wick enough room to naturally form, all while safely protecting the specific T-spot area you want respected.
So when you're staring at your charts, you really have to ask yourself, which protected swing actually makes sense for my stop loss? There's an awesome AUD/USD hourly example in the source that shows a V-shaped reversal. Before the open, the lower time frame actually had several valid protected swings. But if you just blindly grab the tightest one, you'd be in serious trouble. Only the deeper swing gave the daily candle enough breathing room to comfortably form its wick safely, while still respecting the overall equilibrium of the setup.
Because here is the harsh reality. If you get overly aggressive and stick your stop loss on a protected swing that's positioned poorly relative to the EQ, meaning it doesn't give the market enough room to breathe and retrace into that T-spot, expect to get taken out. Seriously, the market will naturally retrace to form its wick, and if your stop is sitting above the equilibrium line where price is drawn to anyway, you're going to get swept literally right before the expansion happens. Talk about frustrating.
Okay, let's bring it all together in Part 5, Risk, Reward, and Adjustments to Protect Your Capital.
This is the final, non-negotiable component of a successful positional entry. Your mechanics absolutely have to align with sound risk management. Across all the diverse examples in the source material, whether it's AUD/USD setups using correlations or that silver trade we talked about, the baseline target for these aggressive expansions is always a solid 2R, meaning you're consistently aiming to make twice the capital you risked.
But what happens when the math just doesn't line up at the open? You don't force it. You follow a simple 3-step adjustment process. First, check if placing your stop on the safest protected swing, the one actually respecting the EQ, allows for a 2R target. If yes, boom, execute your positional entry at the open. But if no, you have to manipulate your entry. You might just need to patiently wait for a slight pullback into a fair value gap. That tightens your entry price, improves your margins, and makes that 2R totally viable again.
And once you're actually in the trade, you've got to manage it. Aim for that 2R target, or maybe specific liquidity points your indicators are flashing. Crucially, if the market starts expanding and forms a new protected swing, trail your stop loss, protect that capital. And hey, if you hesitate at the open and miss the positional entry entirely, don't panic. Intra-candle setups, waiting for that change in the state of delivery inside the candle, are always a fantastic backup plan to get you on side.
Before we wrap up, I need to give you a very real warning. Positional entries require a ton of deep trust in market structure, a solid grasp of intermarket correlations, and a highly nuanced understanding of things like equilibrium. Because of that, the source explicitly advises that if you're a newer trader or you're just new to the fractal model in general, leave positional entries alone for now. Stick strictly to intra-candle confirmations. Master the basics before you start trying to front-run the expansion. Which leaves us with one final thought to chew on. True market mastery isn't just about reading indicators after the fact. It is about confidently anticipating the expansion and having the mechanical courage to position yourself before the move even begins. By utilizing protected swings and respecting market equilibrium, you really can catch those trades that leave everyone else totally behind. So the next time you see a perfect structural setup forming at the open, ask yourself, are you going to wait around to be proven right, or are you going to position yourself ahead of the curve? Thanks so much for tuning into this explainer, and keep learning out there.